Welcome back to The Explainer. Today, we're jumping straight into the absolute battleground that is the July 2026 crypto market. Seriously, looking at the charts right now, it feels like an epic clash of titans. We've got massive macroeconomic forces trying to drag the market down, colliding head-on with explosive technological adoption pushing it right back up. So today, we're breaking down exactly what's happening, who the key players are, and the ultimate hurdles standing in the way of the next big run. Smash cut to today. Bitcoin just completely shattered that stubborn $65,000 resistance level. We're talking a massive bullish rebound, trading right around $66,555. And the crazy part? This tactical recovery is actually being driven by a strong bounce in US AI chip stocks like SanDisk, Western Digital, and Micron. As traditional equities refocus on the whole AI theme, crypto is catching that tailwind, shifting the market's fear and greed index up from extreme fear just a few weeks ago. All right, so let's map out this July market battlefield, because to really grasp this recovery, you have to see the massive opposing forces colliding right now. The market didn't just organically dip, it's been violently pulled in two completely different directions. On one side, you've got the bears wielding this brutal, perfectly scheduled halving crash. Historically, you know the drill. Bitcoin peaks roughly 12 to 18 months post-halving, and then boom, sharp correction. And man, this cycle followed that script aggressively. Since hitting that insane $97,000 high back in January, we watched a massive drawdown erase, get this, over $24,000 from every single coin. It literally dragged BTC down to a 21-month low of $58,188 in late June. But this relentless downward pressure, it wasn't just cyclical. It's been heavily fueled by some severe macro headwinds. We're looking at an escalating US-Iran conflict with consecutive nights of strikes, which is pushing crude oil past $80 a barrel and, frankly, reigniting heavy inflation fears. Because of this, Bank of America is actually out here forecasting 3 consecutive interest rate hikes for the second half of 2026. This heavy macro gravity is just a massive threat to risk assets across the board. But right when the market looked totally bleak, the bulls unleashed a massive, fundamental power-up to counter all that macro gravity: real-world assets and artificial intelligence. We're not just talking about hype here. This is actual, tangible adoption acting as a shield against the sell-offs. The momentum here is honestly undeniable. The RWA, or real-world asset market cap, has basically quadrupled in just 15 months to a staggering $19.39 billion. That proves we're seeing real, sticky institutional demand. We're way past the days of just crypto-native yield farming, right? We are talking about traditional finance giants migrating actual treasuries, commodities, stocks, and ETFs straight onto the blockchain. Just look at tokenized treasuries. They alone account for about 2/3 of that entire RWA sector, leading the charge across multiple chains. You've got established heavyweights like Circle with their USDC token and BlackRock with their BUIDL fund holding well over $2 billion each. And right on their heels, Ondo's USDY with over $1.3 billion. Make no mistake, this is a mature phase of the cycle where real-world yield is being securely ported on-chain. And alongside those RWAs, we're witnessing an epic convergence with artificial intelligence. Traditional titans like Franklin Templeton have actually come out and explicitly named agentic AI as the ultimate catalyst for decentralized networks. The broader market is finally waking up to the fact that if autonomous AI agents are going to conduct real commerce, they absolutely need decentralized rails to do it. Blockchain is literally becoming the financial infrastructure for the AI revolution. But hey, it's definitely not just the institutions having all the fun. The sheer speed of this recovery is being heavily fueled by retail, and nothing illustrates this better than the meteoric rise of the Robinhood Chain ecosystem. While the big suits build out RWAs, retail and developers are just flooding into this vibrant new network. I mean, check out this adoption rate. In a mere 3 weeks since its mainnet launch, Robinhood Chain has locked in over $430 million in total value locked. Developer activity over there is already ranking second, trailing only mature networks like Ethereum. And in that exact same tiny 3-week window, transaction volumes have completely blasted past the $3 billion mark. $3 billion. It is just a breathtaking pace for ecosystem expansion. And this rapid expansion is creating a seriously kinetic wealth effect across the board. Native tokens on the Robinhood chain are absolutely flying. Take Pawns, for example. It surged 129% in a single day. That massive jump was largely driven by direct endorsements from the Robinhood CEO and the rollout of highly anticipated limit order features, which just sparked intense social media FOMO. Oh, and in a hilarious twist of market humor today, a short-bodied raccoon meme token named Jimothy surged over 100%. It grabbed massive traction on social media, which naturally led to a centralized exchange listing that pulled in heavy speculative capital. It just goes to show, despite all that institutional maturity we just talked about, raw speculative energy is still very much alive and well in the crypto space. So here's the crucial takeaway. While the bulls definitely have those fundamental power-ups, from BlackRock tokenizing assets to AI agents conducting commerce, they are rapidly approaching the ultimate barrier, the big one, what we're calling the regulatory final boss.
Enter the Clarity Act. This is a massive piece of legislation aiming to finally divide SEC and CFTC oversight and hand this industry a clear rulebook. But right now, it is facing an absolute finish line crisis. The bill passed the House with strong bipartisan support, and the Senate Banking Committee even advanced it in May. But today, thanks to political negotiations, some new ethics rules enforced by the DOJ, prohibiting federal officials from issuing tokens, and a ticking clock, it's completely frozen. If they don't get this passed before the Senate's August 7th recess, it might get pushed all the way into the 2026 midterm election cycle. And honestly, that would be a catastrophic delay.
As Senator Cynthia Lummis so perfectly pointed out, this agonizing regulatory gridlock threatens to exile top talent right when mainstream adoption is truly taking off. Without crystal clear rules on when a digital asset is a commodity versus a security, businesses are backed into a corner. They have to choose between innovating in the dark or just packing up and moving overseas. Meanwhile, the new Genius Act is proposing strict bank-grade KYC, know your customer rules for stablecoin issuers. And this is violently sorting the market into two camps. On one side, you have clear regulatory winners like USDC. Their parent company, Circle, already complies with strict corporate verifications and is registered under Europe's MiCA laws. On the flip side, you have Tether's USDT, which has historically pushed back against strict registrations, leaving them with a really uncertain compliance path in the US primary market. So, who survives the chaos? It truly is a clash of titans out there. We have this rapid, vibrant blockchain innovation and massive institutional adoption colliding head-on with heavy macroeconomic gravity and frustrating government gridlock. We're watching a real-time sorting mechanism unfold, where only the projects with real utility and clear regulatory compliance are going to survive and thrive. Which brings us to the final question you need to take away from this explainer today. Will these fundamental power-ups, the billions flowing into tokenized assets, the blazing speed of new chains, the epic convergence with AI, be enough to defeat the regulatory final boss? Or will the political gridlock and macro threats drag the market back down into extreme fear? Keep your eyes locked on that August recess deadline, because that is likely going to dictate the rest of the year. Thanks for joining me on this deep dive. Stay curious, and I'll catch you in the next explainer.